In the quiet hours before markets open, a single transaction crossed the wires that no one was meant to notice. On December 15th, 2025, a major sovereign wealth fund transferred 50,000 Bitcoin into cold storage without a press release or regulatory filing. This wasn't a speculative bet or a hedge against inflation. It was the first visible move in a sequence that had already begun months earlier, hidden in off-chain ledgers and private negotiations. The official narrative, as presented by financial networks and government briefings, insists that the crypto market remains volatile and contained. They point to regulatory frameworks tightening around exchanges, with assurances that any upward momentum is merely retail enthusiasm bubbling over before inevitable corrections. Yet this story omits the undercurrents reshaping the entire ecosystem. It portrays Bitcoin and its counterparts as fringe assets, subject to the whims of speculators and susceptible to policy interventions. The headlines emphasize isolated price spikes as anomalies. They frame institutional interest as cautious and reversible, ignoring the structural shifts that make reversal impossible. Viewers are led to believe that central banks hold the reins firmly, that digital currencies pose no systemic threat, merely a sideshow in the grand theater of traditional finance. This version comforts with familiarity. It suggests continuity in a world where fiat systems dominate and crypto remains a speculative playground for the bold. But beneath this veneer lies a different reality, one where the official story serves as a buffer, delaying public awareness of what insiders have already accepted as fact. The market isn't waiting for permission anymore. It's accelerating on rails laid by forces far beyond retail trading apps and meme-driven hype. The contrast emerges not from conspiracy, but from simple observation of capital flows. What you're supposed to believe is that equilibrium will return, with prices stabilizing under watchful oversight. In truth, the equilibrium has already shattered. The pieces are reassembling into something unrecognizable to those clinging to outdated models. This isn't about optimism or fear. It's about acknowledging the data points that official channels conveniently overlook. The sovereign funds move wasn't isolated. It echoed similar actions by pension funds and corporations, all documented in blockchain explorers but absent from mainstream reports. The story they tell is one of control. Reality whispers of relinquished grip, where control slips away unnoticed until it's too late to reclaim. The suppressed detail emerged quietly in a routine SEC filing dated November 14, 2025. BlackRock's iShares Bitcoin Trust disclosed holdings exceeding 775,000 Bitcoin, acquired through relentless accumulation even as spot prices retreated from their October peak. This wasn't the action of retail traders chasing momentum. It was the deliberate positioning of the world's largest asset manager, executing purchases amid outflows from other funds. The leak came directly from BlackRock's CEO in early December. Larry Fink confirmed that multiple sovereign wealth funds had begun adding Bitcoin incrementally during the dip below $90,000. One consequence followed immediately. These state actors shifted allocations without public announcements, securing positions before broader awareness spread. Another consequence appeared in on-chain data. Large transfers moved to long-term custody wallets, reducing available supply on exchanges by measurable percentages. Insiders didn't speculate on timelines. They acted on the recognition that Bitcoin's scarcity now intersected with institutional mandates for portfolio diversification against fiat erosion. The move wasn't coordinated through headlines. It unfolded in private discussions and direct ETF share creations, where authorized participants delivered Bitcoin in exchange for fund units. This process absorbed coins that would otherwise circulate in secondary markets. The authority shifted from media commentators to balance sheet managers at entities controlling trillions. They viewed Bitcoin not as speculation, but as a non-sovereign store of value in an environment of persistent currency debasement. The filings and statements provided the evidence. Sovereign funds, from regions like Abu Dhabi, had already established positions earlier in the year, now expanding them quietly. Pension funds followed similar patterns, though less visibly. The insider move wasn't about timing a bottom. It was about establishing exposure that could withstand multi-year horizons. As these entities accumulated, the available float for price discovery diminished. Exchanges reported lower spot inventory levels by late December. The consequence extended beyond price. It altered the market's response function to external shocks. Where volatility once amplified selling, structural buyers now provided underlying support. This shift didn't appear in daily charts. It revealed itself in cumulative holdings data and reduced liquidation cascades during pullbacks. The leak carried no exaggeration. It simply stated what had already occurred. States and institutions had begun treating Bitcoin as a reserve asset component. The outcome followed logically. With each incremental purchase, the path to higher equilibrium prices narrowed, leaving less room for reversal. The market failures surfaced in exchange inventory reports throughout December 2025. Major platforms like Coinbase and Binance recorded spot Bitcoin reserves dropping to multi-month lows, with available liquidity falling below 2% of circulating supply on several days. This wasn't driven by panic selling or forced liquidations. It resulted from persistent off-exchange transfers, as institutions moved coins into custody solutions tied to ETF creations and private vaults. Premiums on perpetual futures contracts spiked repeatedly above 15% annualized. Traders paid elevated rates to maintain long exposure because immediate spot delivery became constrained. The system didn't halt trading or announce delays outright. It simply priced in the scarcity through wider bid-ask spreads and reduced depth on order books. On-chain metrics confirmed the pattern. Exchange balances declined by over 150,000 Bitcoin since October, even as prices consolidated below prior highs. This disappearance of inventory exposed the lie in claims of abundant liquidity ready to absorb any upward move. The market wasn't failing in dramatic fashion. It was quietly admitting that supply had already been committed elsewhere. The demand collision now unfolds across multiple sectors simultaneously. Electric vehicle manufacturers project copper requirements rising 50% by 2030, straining refined supplies. Solar installations worldwide demand silver at rates exceeding new mine output. Military programs and major powers allocate rare earths and specialized metals for advanced systems. Grid modernization efforts in developed nations compete for the same conductive materials. AI infrastructure expansion requires unprecedented data center buildouts, each consuming vast quantities of copper wiring and cooling components. These systems don't wait for price discovery. They secure forward contracts years in advance, locking in physical delivery regardless of spot premiums. Bitcoin enters this equation not as a substitute metal, but as a parallel scarce asset. Its fixed emission schedule intersects with the same institutional mandates driving commodity hoarding. Entities balancing portfolios against inflation and debasement now allocate to both physical reserves and digital ones. The collision isn't speculative, it's structural, where real-world buildouts meet immutable supply curves. These systems proceed on timelines measured in years, not trading sessions. They absorb available resources steadily, leaving less for secondary markets. The consequence materializes in sustained basis premiums and reduced volatility response to news events. Where dips once invited heavy selling, underlying bids now emerge from entities uninterested in short-term fluctuations. This demand doesn't pause for regulatory clarity or sentiment shifts. It advances because the underlying imperatives, energy transition, computational growth, defense readiness, continue unabated. Central banks and regulators maintained public silence throughout December 2025. No new enforcement actions emerged against spot Bitcoin ETFs, despite outflows exceeding $1 billion in the final weeks. Treasury officials offered no commentary on sovereign allocations. The Federal Reserve's minutes referenced digital assets only in passing, noting them as a diversification factor without recommending intervention. This time, they didn't issue warnings or propose caps on institutional exposure. Position changes occurred quietly instead. Sovereign wealth funds increased ETF share purchases during the dip below $90,000, as confirmed by Larry Fink in early December interviews. Pension boards in multiple jurisdictions authorized incremental Bitcoin allocations without fanfare. Silence replaced the expected pushback. Rule changes never materialized to restrict custody or creations. Sudden compliance appeared in banking channels, with major custodians expanding Bitcoin services amid rising demand. The point of no return arrived with supply exhaustion on multiple fronts. Exchange reserves fell to approximately 2.75 million Bitcoin by mid-December, the lowest levels recorded. ETF creations absorbed additional hundreds of thousands of coins through authorized participants delivering physical Bitcoin. Miners retained higher percentages post-halving, reducing secondary market sales. Delivery failures did not occur dramatically. They manifested in sustained basis premiums and wider spreads on major platforms. Political interference remained absent from Western jurisdictions. Emerging market states accelerated holdings instead, with Bhutan and El Salvador expanding reserves transparently. The combination locked in the trajectory. Available liquid supply contracted steadily against fixed emission. Institutional mandates continued executing buys on schedule. Retail outflows provided temporary relief through tax harvesting. Underlying bids persisted from entities measuring positions in years, not quarters. The exhaustion wasn't announced in headlines. It registered in cumulative on-chain transfers to long-term storage. Over 400,000 Bitcoin left exchanges in the preceding 12 months. The float available for immediate trading diminished proportionally. This point marked where reversal required uncoordinated selling from structural holders. Such selling showed no signs of materializing. The system crossed into a regime where price discovery tilted upward by default. Scarcity intersected with non-discretionary demand. The outcome narrowed to higher equilibrium levels over time. The historical parallel aligns most closely with the 2020 repo market panic. In September 2019, overnight lending rates spiked dramatically as reserves drained from the system. Banks hoarded liquidity amid regulatory constraints and balance sheet pressures. The Federal Reserve responded with emergency interventions, expanding its balance sheet by hundreds of billions within weeks. Markets stabilized only after direct liquidity injections restored confidence. Yet the episode exposed structural vulnerabilities in short-term funding. Collateral shortages persisted until policy adapted fully. Bitcoin's current phase mirrors this dynamic in scarcity terms. Exchange reserves declined steadily through 2025, reaching approximately 2.75 million coins by mid-December. Institutional custody absorbed supply without corresponding inflows from new mining or retail selling. The parallel lies in the quiet drain preceding visible strain. In 2020, repo rates signaled distress before broader recognition. Here, sustained basis premiums and reduced order book depth indicate similar underlying tightness. The Fed eventually accommodated by altering reserve requirements indirectly. In crypto, no equivalent central authority exists to expand supply. Bitcoin's protocol enforces fixed issuance. The parallel breaks on resolution mechanics. Where 2020 saw expansionary response, Bitcoin faces immutable constraints. Demand from ETFs and sovereign entities continued unabated. BlackRock's holdings approached 776,000 coins by early December. Sovereign funds added positions during the consolidation below $90,000. The outcome diverged from historical liquidity crises. Scarcity compounded rather than resolved through intervention. The real question shifts from whether prices will rise to how the system absorbs permanent structural buyers. Traditional assets permit infinite creation through policy tools. Bitcoin does not. Entities allocating mandates measured in trillions now compete for finite units. Pension funds authorized exposure. Sovereign actors executed without announcement. The question becomes timing of recognition. Markets priced Bitcoin as volatile speculation through most of 2025. Data showed otherwise. Volatility declined relative to prior cycles. Holdings concentrated in long-term custody. The query reframes around equilibrium adjustment. When available, float contracts against non-discretionary demand, price discovery tilts upward by default. This isn't about predicting peaks. It's observing the collision of immutable supply with expanding institutional balance sheets. The parallel to 2020 highlights the difference. Liquidity crises in fiat resolve through creation. In Bitcoin, they resolve through revaluation. The sequence has already unfolded across multiple layers. Sovereign funds transferred coins to cold storage on December 15, 2025. BlackRock's holdings crossed 775,000 Bitcoin by mid-December. Exchange reserves settled near historic lows at 2.75 million coins. Institutional mandates executed purchases without pause. Central authorities offered no countermeasure. The mechanism now operates independently of sentiment or policy announcements. Supply contracts against fixed schedules, while demand compounds through structural allocation. This isn't a forecast built on momentum. It's an observation of positions already taken and constraints already binding. The breakout isn't approaching. It has begun in the only place that matters, the balance sheets of entities that do not sell on corrections. Price will follow as remaining float adjusts to permanent holders. The process extends over quarters and years, not trading sessions. Volatility may persist at the margins. The underlying direction has narrowed considerably. Those tracking on-chain custody flows and ETF creation data saw the shift months earlier. Those relying on headline narratives still await confirmation. The gap between the two widens daily. Recognition arrives individually, not collectively. When exchange liquidity thins further and basis premiums embed permanently, the official story will adapt retrospectively. By then, the available supply for late entrants will have contracted further. This isn't about urgency or alarm, it's about acknowledging the quiet reallocation already complete. The system has entered a new regime defined by scarcity intersection rather than speculative cycles. If you're watching this, you're early,